Hi, I'm Jessica Amir for the Finance News Network at the 2017 Self-Managed Super Fund Summit, and joining me from the Trobe Financial is CIO Chris Andrews. Welcome, Chris.
Hi Jessica, great to be here.
Thanks for coming. So can you tell us, Chris, what are your key takeaways for self-managed super fund trustees?
Well, in the low interest rate world we're in today, investors, particularly self-managed super fund investors, those at or near retirement, they're facing some real challenges. With interest rates so low, frankly, their portfolio performance is really getting stressed. Now, the risk obviously is that those investors take significant steps up the risk curve to try and compensate from that, and that of course exposes them to things like sequencing risk, which can be really harmful for their portfolio's performance.
So Chris, what is sequencing risk?
Thanks Jessica. Look, sequencing risk is the risk that investors experience negative returns just as they enter that drawdown phase, the retirement phase, if you like, of their investment life cycle. Now, of course, the problem with that is if you're experiencing negative returns as you're drawing down from your investment portfolio or from your self-managed super fund, you're crystallising losses. That's money that can never be recovered, whatever markets do down the track. So it means sort of the long-term performance of the asset class becomes less relevant, and what becomes really important is your year-to-year returns.
Good point. So what about, we've heard the term bandied around today and previously, peer-to-peer investments. So what are peer-to-peer investments?
Peer-to-peer investment, it's the flavour of the month. Everyone's talking about it, which is a little bit surprising to us. I've got to say, we've been doing it for 25 years. That being as it is, peer-to-peer investment is an investment model where investors get to choose individual loans and invest in them. So classically, of course, an investor investing in loans, mortgages or unsecured loans, would invest in a portfolio of those loans put together by a manager. In the peer-to-peer model, the investor gets to choose loan by loan the investors that suit their own risk, return, duration needs. And of course, what that means is for investors, it's putting them very much in the driver's seat.
Touching on something a little bit different now, what about investing in credit or debt?
Yes.
What are the advantages and disadvantages of investing in that?
So credit investment is a really powerful tool to control the sequencing risk, volatility in portfolios that we were talking about earlier. Because of course, when executed properly, credit investment delivers capital stable, reliable income returns. Now that's what Trobe Financial as a credit manager is always trying to do for investors, of course. The risks in the sector are the same as with any asset manager, and investors really need to be aware of three key points. Firstly, who is your manager? What is their track record? What is their expertise? So that's the first thing. The second thing they need to be aware of, what is it that they're investing in? Do they actually understand the assets? Do they understand the manager's approach to the assets? Do they understand the manager's resources to bring to bear to manage and control those assets? And then finally, investment structures. We are forever saying for investors, be aware, be alert. If investment structures seem complex, if they're opaque, if you don't understand what's actually happening, the decisions that the manager is making, then you shouldn't invest. It brings us back to that famous Warren Buffett saying, which we repeat endlessly. Investment is not like Olympic diving. You don't get bonus points for degree of difficulty.
It's been a real pleasure. Thank you so much, Chris Andrews, CIO of the Trobe Financial.
Thanks, Jessica. It's been great.